What's going on, everybody? Pup of Wall Street back with another workshop. Today is Tuesday. Markets close tomorrow, so that's why we're doing it on a Tuesday. All right. So no real specific plan tonight. What I want to do first is just review a couple of the more recent trades. I think that makes the most sense just to kind of talk through a little bit of the trading psychology, what I saw, why I took what I took. So let's just talk about today. What was this morning? That was ARM. Okay, so let's talk a little bit about this chart. I'm going to first go up to the weekly, right? So this is the weekly on ARM. You could see IPO was September 11th, 2023. Right? And it came down, it hit about $46 and then it started to move up. This is pretty much where I started to get interested, right around this like 50 to $60 mark, somewhere in here. And then you could see over 65, like we broke out, we back tested, and we had this monster move up the week of February 5th. And then the next week, the week of February 12th, we had a continuation and then kind of an inverted hammer here, right? And then it just started to kind of drift. It started to drift back. And then here, right, kind of close to the prior highs, not really coming back all the way down, but we came to the trend line, right? We had two touches right here. You draw the trend, look at the third touch right there. Inside day or inside week, inside week, inside week, inside week, inside week. Then 3 weeks ago, we started to break out again. And that's where I think it really started to get interesting. So then when you look at the daily chart, right, I'll hide this for a second. What I started to notice after the IPO bottomed was this wave count, right? So there's your wave one. Let me grab my little tool here. I like my little tools. All right. So let me actually, before I do that, let me hide all of the drawings. This way it's a little easier to see. And let's grab the drawing tool again. All right, perfect. Right. So this is what I saw. So you had a move to the downside, right? And then you started to see a low, a higher 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 low, right? By this higher low, you got to know something's going on, right? So here's wave one, here's your wave two pullback. Here's wave three. Sorry, here's wave three. Here's your wave four triangle. Here's your gap up in wave five. And that was the end of the first sequence of 5 waves. So generally, after you see a sequence of 5 waves moves up, you generally get an ABC retracement. So here's your wave A, right? Here's your wave B, and here's your wave C. And usually it happens to terminate near the base of wave 4. We didn't quite come all the way down, and we didn't actually fill this gap here. But now we're starting a new move higher, right? So here's a higher low, or here's a low, higher low, higher low, higher low. We kind of haven't made that new higher low up here. But again, like what's going on? Could this be a 1-2, 1-2 setup? That's likely what's happening. And if this is a 1-2, 1-2 setup, then 1-2, right? And then your second 1-2 is your 1-2 in wave 3. And this is wave 3 of 3. And wave 3 of 3 tends to be the strongest wave. It tends to be the longest wave. It's never the shortest, but it tends to be the longest. And I think that's what we're seeing right here. Okay, we talked about waves. We don't have to talk about waves anymore. But now, when I'm looking at this, it's interesting, right? Because when you have a wave, and I said we're not going to talk about waves, but I'm just seeing this as I'm charting it. But this initial wave move up, this actually could be a big time frame wave 1. And this could be wave 2. And this could be the start of a larger time frame wave 3, right? So I didn't really see that before, but I'm starting to kind of see that now. Yeah, somebody said waves, surf dog. So anyway, why is that important? Because knowing what wave you're in will give you confidence in terms of the momentum and um, the thrust of the wave. How much can it go? I always try and get in on the wave three because the wave three tends to be gappy, right? It gaps up a lot. You'll usually have multiple gaps in wave three. It tends to be a violent move higher, right? We can look at old Tesla charts from 2021 that it was just an insane move higher. And that's exactly what we're seeing right now in some of these semiconductor names. So, all right. So you have the ABC move back, right? And now you're seeing the break here, the break of was it 119, 117? It was somewhere in here. That's where I kind of started to say, let's start getting interested again, right? Because my initial plan was the entry over $56, and then I wasn't in the room at that time, but I was in the room in May, and I said new entry over 115.50, and that was right around here, right? Because we had this major fib cluster between 114 and 119, and look what happened when it broke over that fib cluster, right? Let's zoom in a little bit, right? So here, we broke over the fib cluster, we back tested the fib cluster, we held it for 3 days, and then we were off to the races, right? So that brought us basically to this week, right? So, or last week. So on Wednesday last week, we broke over the wave B high, which is 147, and we went straight to all-time highs. That all-time highs was on Friday. We tested all-time highs. That's what got me really interested. That said, pup, you need to pay attention. This thing is going to break out. And so that was right around here. And so this morning, I saw a little bit of movement first thing. Let's go down to like a 30-minute chart, and I'll show you the open was right here, right? First opening minute, 30-minute candle, first opening 30-minute candle, we test 163.66. Now remember, that what I said this morning was watch the break of 166.36. This thing can really go, right? We broke out. Let's go down to a 5-minute chart. Right? Look at the open was right here. 5-minute test, 5-minute test, 5-minute test, fail. It pushes down, it undercuts the low a day, and then it reverses and starts to go back higher. So what do I always say? All right, let's play a little game. For those of you who have been in my workshops before, what do I usually say? How many tests it usually takes for a breakout to happen? Anybody in chat? 3. So here's your first test. Let's zoom in. Let's grab the little tool. All right. Here's your first test. Here's your second test. And here's your third test. And the third test got rejected. So that's fine. But now you pay attention. You wait for that fourth or fifth test and you take the breakout. That's exactly what we got. Came a little close here on that 5-minute candle. Didn't quite test it. But that fifth test right here, boom, breakout. Second 5-minute candle after the breakout, a little bit of indecision. Third one continued right to 166.30, right? And so now you have test, third, breakout. Boom, higher. All right, guess what? I missed it. Where do I get back in? On the prior back test, right there. You get in on the back test. Now, the problem with that back test is you get a flush candle right there. That's the stop loss hunter, right? So the best entry is right here. And if you get in here, this little push back, this little push under, this flush candle it shouldn't shake you out, right? Let me turn on the 21 EMA, and let me also turn on the 5, right? So I look for the undercuts of the 21 and the 5. It's kind of what we get on that back test candle. But again, this is why getting the right entry is so important. It's super important because if you chase, let's say you chase up here or you chase right here, and now this undercuts your entry right here, you're gonna be like, shit, now I went green to red. I'm gonna stop out right before they launch it. So this is why getting that proper entry is so important. But once you get that push back up, look at how it rides that 5 EMA pretty much all the way up. And I mentioned first target's 171, second target's 176. We almost perfectly nail that 176 target, and it starts to reverse into the end of the day. And looks like we're just consolidating in after hours. So that was really it. You know, if you're looking to take a day trade, you have to get granular. You have to get down to the 5-minute chart. You have to start recognizing the signs. You know, what else could we have looked for? Well, let's look and dissect this chart. So that was just pure price action. That had nothing to do with moving averages, squeezes, MACD, divergences. That was pure price action and levels. And that's all you really need as a trader. But sometimes you just want that extra confidence. So here, right on the open, you have a 5-minute squeeze setting up. What do I always say about this, about the slingshot squeeze? The slingshot squeeze tends to be a really nice squeeze to take. And so here's the, you know, I can make this a little bigger. And so you can see the actual sling of the squeeze here, right? So you have the squeeze setting up right here. You have momentum shift to the downside, and it starts to shift right to the upside. And then right here, it fires, right? I want to kind of get in on the shift to the upside. So maybe on this candle right here, maybe on this candle right here. So what else is happening around this candle right here? Well, in 1 or 2 candles later, you get a MACD crossover. You get a bottoming of the Williams percent R, and you get a 521 crossover. So even if you don't get in on this candle, get in on this candle or in this candle or on this candle. But for sure, you want in by that candle because at this point, the move has started. Now, what happens at 10:15, 10:30 in the morning? Hit the chat. What happens at 10:15, 10:30 in the morning? Nobody. Lunch. No. So right at around 10:15, let's say between 10 and 10:30, usually around 10:15, you get that early morning pullback, right? So this right here, this candle right here, that's right around 10:15. Now you're starting to get the early morning pullback. But what happens in this pullback? We're forming a flag. We have a high, we have a lower, we have a high, we have a low. We have a lower high, we have a lower low. We're forming a flag. So let's say you missed this entry. Let's say you missed that entry, right? Let's say you missed the pullback. Buy the break of the flag right there. That's another good entry. So there's multiple ways that you could have entered this trade. What happens after the flag? I mean, come on, we can't make this up. Another slingshot squeeze on the 5-minute. Momentum shifts down, momentum shifts back up. It fires to the upside. You get a big move higher. Ladies and gentlemen, it's not rocket science. It's not difficult. The problem is reading this in real time. That's always going to be the issue when trading. So pay attention, right? Even here, look, another one. Another squeeze setting up. This one's a little baby squeeze because it's at the end of the day. But look at the momentum shift to the upside. Another larger than expected move. And so that's why I love trading with the squeeze. I don't need anything else. I like to add, you know, the MACD and the Williams percent R, you know, look for divergences, look for crossovers, but give me a level, give me a squeeze, and I will crush a trade. And that's all you really need. But that's me. That's how I trade. It's not necessarily how you should trade, but play around with it. See if it works for you. It works for me. It didn't work for me for a long time because I didn't really understand how effective it was. But once I really started to understand how to use the leverage of options and using a squeeze, in this case, I took a slightly longer dated contract than I probably should have, but that was okay. I wanted to buy myself time in case I was wrong. In this case, I was right. And it, you know, the arm, I don't even know what I did. It was the 190 call for July 19th. And I think I paid $1.45 or something like that. And it ran to like $3 when I finally closed the trade. And that was pretty much like kind of up here. And then I just didn't buy the pullback because I was happy with the gains that I took. So you have to, as a trader, you have to determine what your risk tolerance is. You have to determine what your edge is. If you're just following trades or following ideas, you're going to win some, you're going to lose some, but you're going to kind of go back and forth. You know, your P&L will kind of remain the same. All right, so that's pretty much ARM. If there's any questions on that, let me know. Otherwise, we can move on to some of the other charts that I've got my eye on. So another one, CAH, I know was mentioned in chat. Someone got like 160, 170 percent trade on. So yeah, I mean, listen, what I showed you on ARM, that was a 5-minute time frame. Right now we're on a daily time frame. Well, guess what? Here's another squeeze setting up. Here's momentum shifting to the upside. Here's a reversal pattern, a left shoulder, a head, a right shoulder. Here's the breakout. Here's the back test. Here's the back test. Here's the continuation, right? Here's the MACD crossover. Look at the bullish divergence. For those of you who don't know what bullish divergence is, it's very simple. Bullish divergence is when price is making lower lows and your indicator is making higher lows. So the indicator is basically saying something different is happening what price is telling us. And divergence can show up on the Williams percent R. It could show up on MACD. It could show up on RSI. And when you see it on multiple indicators, and let me preface this by saying you should probably never use these divergence strategies on the lower timeframes because they tend to be false signals. Not always, but they tend to be. But when you see them on the higher timeframes, I say the minimum 4-hour time frame. If you start to see divergences set up, that's not a signal to get in, right? Or to go long or go short, but it is a signal to start paying attention, right? So one of the things I'm looking at, well, let's take a look at SHOP. SHOP is another example. Bullish divergence, right? You have MACD and Williams percent R making higher lows, and you have price making lower lows. Eventually, this thing broke out and it made a nice move. Okay. Well, what else is doing that right now? Let's take a look at Disney. Same thing, right? You have price making lower low, lower low, lower low, and you have MACD making higher lows. You have Williams percent R making higher lows, right? There's a higher low, a higher low, a higher low. And you have a squeeze setting up, right? It's why I like Disney. What else? Oxy, I think, was another one. Here's another one, bullish divergence, higher low, higher low, higher low. MACD started to make higher low. MACD just crossed over. We don't have any squeezes, but look what happened today. We broke out. Look at the breakout candle, but it cheated, right? It gapped over the resistance level. So you had a false breakout here, you had a rejection here, you had a gap over right there. But look at the above average volume. That's what you want to see. Now, why didn't I take the trade? No squeezes. I want a squeeze because I want that extra punch higher. I want that quick premium expansion on options contracts. So, it's still a good trade. Don't get me wrong, right? At a support resistance flip zone, all that jazz. But it just didn't give me the oomph that I wanted. CELH, dog. What a dog, right? Double top breakdown. We rode this puppy all the way down, right? Here's your one top. Here's your double top. There's your double top breakdown. But I got in early because I just recognized, I saw what I saw, breakdown right there. You get in on short. And by here, I recognize this is a potential 5-wave move down. And so here's your wave 1 down. Here's your wave 2 retracement. Here's your extended wave 3 down. And what we're potentially seeing is a wave 4 retracement. And I think that goes back to 68.50. So what was I looking for? Well, guess what, ladies and gentlemen? Bullish divergence. Look at the MACD, how it's starting to flatten out. This thing will likely cross over sometime later this week, if not early next week. So that's why I took the trade this morning. I was actually chatting with Wall Street Engine on the side, and he was like, "Hey, are you seeing what I'm seeing?" I'm like, "I'm seeing what you're seeing." And even though I'm like super bearish on CELH, I'm looking at this as a reversal play because, it's made a pretty big move down in a pretty short period of time. Like we're talking about, I don't know, we're talking about a 40% move down in 3 weeks. That's a big move down in a very short period of time. So I want to play, I want to play a reversal, but I'm not going to just play any reversal. I'm going to look for the level where I think it's going to reverse off. So we had a 1272 extension to the downside of 59.01. We got a spinning top yesterday, and we pushed back through the 786 at 60.11. So that, for me, that was the area, right? Bullish divergence, MACD flattening out. Of course, no squeezes, not a big deal. If we look to the lower time frames, we probably have squeezes down there, right? Here was a 30-minute squeeze, but that was to the downside. No 5-minute, no 65-minute, no 4-hour. All right, no squeezes, no big deal. All that's saying is we're probably just not going to get a lot of momentum to the upside, and that's okay. I think these contracts are already up like 20, 30, 35%, whatever. But again, these bullish divergences didn't show up on MACD, but it showed up on the Williams percent arm. So, all right. So Grateful Surf Dog is asking, do you use RSI divergences also? I do, but I have been playing around more with the Williams percent R for the last, I used it a couple of years ago, and it didn't give me an edge, but I've been using it a lot more the last like 3 to 4 months, and I've been doing some back testing. I built a scanner on it, and I'm starting to like it a little more now that I'm understanding how I can fit it into my overall strategy. And so look, when you use the Williams percent R versus RSI is not telling me that there is a divergence here. It's just making lower lows. But Williams percent R is making higher lows. So this is, for me, this was a better indicator in terms of what was potentially happening with the stock. Okay. All right, let's take a look at some of the other ideas that I've been putting out. So GEV, this is one of the GE spinoffs, General Electric spinoffs, GE Verona. I don't exactly remember what this particular spinoff does. I know GE Normal is aerospace. Not exactly sure what this one, if anybody has it, knows in the chat, put it down, but I don't really care what it does, to be honest with you. I only care what the chart setup looks like. And this one looks pretty good, right? Anchored VWAP bounce, right back to all-time highs. It's a recent IPO. We did close over the breakout today. So this one looks pretty good. Targets 197, 223 to the upside. We talked about CELH. Let's take a quick look at MBLY. I've been very, very patient on this one. No entry here on MBLY just yet. In fact, MACD looks like it's crossing under. So this one, it may need to come down to 25 and test this this zone right here. Let's see. This zone is basically right here. That might be the area to watch for a pullback entry, but right now it's off the table. I'm not really going to be paying too much attention to it. But I will, of course, set alerts. Now, next up, SMCI. Okay, here we go with the waves. Here we go with the waves. I said I wasn't going to talk about waves. I lied. I'm a liar. We're talking about waves again. SMCI. So, it kind of did its thing back here. We don't really care what happened back here. What we care about is that move right there. And what does that tell us? That is wave 3 activity. Whenever you see a wave 3, when you see a big move like that, guaranteed it's a wave 3, right? So here we go. Wave 1, 2, wave 1, 2, 3, 4, 5. That's your wave 3. And what do we get after we get our wave 3? We generally almost always, not always, but almost always get a symmetrical wedge or some form of falling wedge. And that's what we have here. And I've been following this chart for a couple of months now. I mean, this thing started setting up in the wedge back in March. And I keep saying, pay attention, set your alerts, pay attention. And what I wasn't sure of, and I'm still not 100% certain on, is where we are. I know we're in wave 4, but I don't know if we're beginning wave 5 or we're at the end of wave 4. So how do we know? So here's wave A, B, C. This is A. Here's A, B, C. This is B. Here's A, B, C. This is C. And this could be the end, right? It could be 1, 2, wave 3, 4, 5. Or this could get rejected at 949 and then do another A, B, C. And this would be D. And then this would be E. So we don't know yet. What we will know is if we get over 949, then it's very likely that this is going to be wave 3 of 5. 1, 2, 3 of 5. Where will we go? Probably 1109 to 1136. And then we'll probably back test 949 for your wave 4 of 5. And then wave 5, maybe it gets up to 1219. Maybe it gets up to 1453. We won't know until we start to see more of this wave 5 play out. But this one, like ARM, can really move. And being in the semiconductor space, it's really lagged behind NVIDIA, right? So that's why I'm really starting to pay attention to ARM and to SMCI. And I'm really going to continue to scalp these moves because I just want to just milk this thing to the upside as much as possible. I'm not trying to time the bottom. I'm not trying to time the top. I'm not trying to go 3 months out. I just want to play along the way. And again, you have to determine for you what strategy works better for you. Are you better at buying and holding for a longer period of time? Then you buy, a contract 1 or 2 resistance levels out, but like 3 months out, right? All right, so Chris is asking a question. When you're looking at these charts, I can see that your forward-looking window is different for each chart. Is that a rough indicator for what you think the end of the phase might be? E.g., for example, in this chart, you're looking out to October. It's very difficult to determine time, especially when you're doing Elliott Wave. Now, one thing I will say when you're looking at waves is your wave 2 and your wave 4 won't be equal. So if you get a shorter in duration wave 2, right? So wave 2, then you're very likely going to get a longer in duration wave 4. And conversely, if you have a longer in duration wave 2, which is very rare, you'll have a shorter in duration wave 4. So normally you see a shorter wave 2 and a longer wave 4. And a lot of the times when I'm just sifting through charts, I'm looking for these larger frame triangles that have a big run up into them, because it's very easy to determine where we are in that move. It's very clear to see that these larger time frame triangles or wedges are more often than not wave 4 activity. So that's like a dead giveaway. Now, how could we determine wave 3 activity? It's a little more tricky, but I'm trying to think if there's a chart, maybe even MobileEye. Let's look back at MobileEye. No, that's not a good example. What's something that's run up a lot in the last few weeks? NVIDIA. Okay, this is a good example. So where is NVIDIA? Now, I think we're in wave five. I'm pretty sure we're in wave five. Um, in fact, I know we're in wave five because I've consulted with somebody that I highly respect from Elliott Wave perspective, and he's confirmed that it's in wave five. But this is wave one. This is wave two right here, A, B, C, right? And here's your one, two. Here's your wave three. This is your big time frame wave three. And here's your wave four of three, and here's your wave five of three. Here's your ABC retracement. That's your bigger time frame wave four, and this is your wave five. Now, what do we see in wave three? Let's zoom in. We see gaps, and gaps are a dead giveaway for wave three activity. You generally start with a breakaway gap. That's what you see right here. And a breakaway gap is when you gap over resistance. So look at the breakaway gap right there, right? It was falling down, it caught the 21 EMA, and then it gapped right over. There's your breakaway gap. And then you have another gap right here. That's your acceleration gap. So you have the breakaway gap, you have the acceleration gap, and then you move up into wave five of three. And then you do your ABC retracement, right? Generally in a triangle, right? That's your falling wedge right here. And then wave five starts. So how do we know where we are in wave five? Well, this looks like a 1-2. So that must be a wave three. And guess what's in wave three? Look at the breakaway gap right there. Look at the acceleration gap right there. And we're off to the races. So I think with NVIDIA, what I'm maybe not seeing here is a wave four or five. And so there might be another possible trade on NVIDIA. I think it's a little risky because this definitely looks like wave one, two. This definitely looks like wave three. Maybe wave four looks like something like this, right? And then wave five, that's going to be your blow off top. Maybe that's at 150, depending on wave three and where wave three ends and where wave four retraces to. Probably retrace down to here, it'll probably look like something like this, and then wave five up to 150. So, but yeah, I mean, this is a great example. You look for the gap ups anytime a stock gaps up, and every time, well, not every, I would say a high percentage of the times a stock gaps up over prior resistance, start thinking, okay, this is probably a breakaway gap and we need to start paying attention. And doesn't mean you jump into the trade right away, right? But it does mean you start looking for potential entries. So maybe on this breakaway gap here, we're looking for a pullback to a 5 or to a 21 EMA. And maybe on this acceleration gap right here, we're looking for the same, right? But again, when you have to determine as a day trader, it's probably not a big deal. You're not really paying attention to this. As a swing trader, you're absolutely paying attention to this. And as a position trader, you're absolutely paying attention to this. But maybe in the grand scheme of things, it's not super important where you get in, so long as you're getting in somewhere near the beginning of the move. Hopefully that makes sense. But really, I kind of danced around your question, Chris, but it's really hard to determine the forward-looking window. It's going to be different based on A, the personality of the stock, B, how it's been moving. There's trades like I think even shop, like shop here, right? Just doing nothing between 70 and 45, right? But then once it got back over 70, it made a nice move higher. And now we're kind of, pulling back. Um, AMD is another one. This is, to me, I want to go up to a weekly chart and I want to turn off drawings. You know, where you start your waves is where like the trend changes. So like maybe like right here. So this looks like it could be, wave one, two, three, four, five, right? And then you got an ABC retracement right here. And then we're starting a new wave, right? One, two, three, four, five, and then an ABC retracement, and now another, right, five wave move up. That's kind of how these stocks work. So let's take a look at this right here, right? So now where are we with AMD? Well, this looks like a 1, 2, right? This looks like a 1, 2, 3, 4, 5. So this is your wave three. Maybe this is an ABC retracement here, right? Maybe this can't be 1, 2 because this two is lower than wave one. So that's not right. So the wave one would have to start here. Maybe this is a larger time frame wave 1, 2, right? And then this is your A, B, C retracement, right? Before wave three starts. I don't know. We have to pay attention. It's hard to say at this junction of the wave count. But that's what I do. I've trained my mind to start looking for patterns. I think patterns are very important. So, you know, the triangles, the large front, like the daily and weekly time frame triangles, dead giveaway for wave four activity, dead giveaway. And there's nothing wrong with like, all right, so some people might say, oh, well, the trend is almost over, but there's still a move. There's still a wave five move. At the very least, wave five can extend up to the top of where wave three stopped, right? More often than not extends past it, but most likely it's gonna at the very least hit the prior high, right? And so for AMD, that's 226, right? And we're at 154, and this is a daily chart. So if we were looking at AMD and we're looking at AMD from a longer term perspective, over 171, most likely we'll see a move back up to 227. Now it's not going to go up in a straight line. Maybe it will. There's a catalyst, but most likely it won't. But look what's setting up here on the daily chart. TTM squeeze. MACD just turned negative, but it's flat, right? We're making higher lows. We don't want it to see it below 149. If we go below 149, then this is probably going to be a deeper retracement. But if we hold over 149, good chance we can see more higher lows, right? So again, it depends on what kind of trader you are. There's a lot of ways to skin this cat. Are you a day trader? Are you a swing trader? Are you a position trader? Like for me, I flirt back and forth. I sometimes will day trade. I'll sometimes swing trade. I try not to turn my swing trades into day trades. I did that a couple of weeks ago with MobileEye, but that was you know, like a black swan type of thing. I didn't expect it to run as hard as it did, as quick as it did. And maybe I got out a little too early, but I was happy with the gains. And that's the other thing as traders, we can't be greedy. We come up with a plan, we stick to the plan, right? And if the plan is we get in at A and we get out at B, get out at B. Because what will happen is if you don't get out at B and you're like thinking, oh, well, C is going to hit, and you start holding and holding and holding. And the next thing you know, we get news the next day, it gaps down, and now all of your gains have disappeared. It's happened to me more times than I wish to admit. I'm sure it's happened to you as well. So the caveat is you're probably going to get out of some moves early. And that leads me back to what I wanted to talk about, which was ATR. Okay. So ATR, 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 ATR. All right. I wish I could. So actually, BNL, somebody wanted to, Zillow, you wanted to go over BNL. I don't think I've charted BNL. So let's take everything off and we'll just leave ATR on BNL. Okay. So let's say we didn't see any of this price action to the left, and we just saw this falling wedge here, right? So we'll draw out our falling wedge. Okay. Let me cheat for one moment. Okay. So let's say we saw this falling wedge and we're like, oh, falling wedge is breaking out, right? Now we can cheat a little bit. And let's say you you were to take your entry off of this breakout candle here. What I would like to do, I don't know this stock, but more often than not, I'm using an ATR of 2. So ATR stands for ATR stands for average true range. This particular indicator is an ATR trailing stop. And so for people who like to take equity positions, this is a beautiful, beautiful tool. So like if you're not options, don't play with this with options, but if you're taking shares, this is a great tool. Um, that the rule basically is when you're breaking over, when you get the flip, when price starts to trade over the ATR, that's your stop loss. You close under the ATR line, you stop out. And it works to the downside as well. Let's say you saw this trend right here, right? And it was breaking down, like right here, it broke down, right? That's your stop, or that's your entry for the breakdown here. You go short here and you use the ATR as your trailing stop. So you short here, right? 3 or 4 or 5 days later, your trade is red because you're short and the price went higher. But the ATR, it didn't go above ATR. And now the next day it goes back below the trigger, the next day below that. And now and then inside day, trigger down, outside day, trigger down. And now you're following. Now you're seeing this consolidation, right? This is probably the area you want to start thinking about. Maybe I need to get out. So you put a line on, the potential upside resistance. And over here is probably where I would have stopped out. But then just 3 days later, if price flips back over ATR, you're definitely stopping out here, right? And so that would be a 10% move. So it's not bad, right? It's a 10% move. So that's how I use ATR when I take equity position, when I take shares of a stock. It works really well when you get directional moves. It doesn't really work well when you get sideways moves. So like if you were, what were we just talking about? CELH, right? I went short here. Technically, I should still be short with that initial position, but I was in options. I wasn't in shares. I wasn't shorting shares. So it just didn't work for me. Now, here's the caveat. If you're trading a name like NVIDIA, or probably Tesla is a better example. Tesla is a little bit more volatile. This was that move that I was talking about. Well, no, this is the 2023 move. But with Tesla and higher volatility names, I like to use a multiplier of 3. It keeps you in the trade a little longer. And so, again, ATR, you're above ATR, you can stay in the trade. You below ATR, you get out. Of course, it gets you out a little early, but it prevents you from taking this drawdown right here, right? Same thing. I think this is the 2021 move. Where is that move? Yeah, this one. So look at this move right here, right? You get the breakout right at $38. Of course, this is pre-split. And you ride this trade all the way up to $140. That's like what? Like a 300% move, 284%. So had you taken shares at that point, yeah, you're gonna have to deal with a little bit of consolidation, but this was the monster move that Tesla made, right? These are the types of trades you want. This was 1100% in 9 months. This could be ARM. This could be SMCI. This could be the next hot name. But if you're taking shares and you want to hold on to those shares as long as possible, use ATR. And again, 9 times out of 10, you're going to use an ATR trailing stop of 2. But for those higher volatility names, you're going to use 3, right? So if you use 2 on Tesla, you're getting out early, right? It stops you out at $63. Still a good trade, right? You get a double, you get 100%, but it prevents you from getting that 284%. Make sense? All right, Chris is asking, have you ever analyzed for pattern consistency on Elliott Wave time frame as a variable, e.g. wave 2 is similar to wave 4 in duration, plus or minus 10%? I know it's likely going to be variable depending on stock size, but curious on whether it is an additional factor or provides additional signal. No, I've never analyzed that. So there are Elliott Wave traders that use timing, fib timing. That's like a little bit above my pay grade. When it comes to fibs and Elliott, well, I would say when it comes to fibs, I rate myself an 8 out of 10, right? And I don't say 10 out of 10 because I don't quite do fib timing, and I would like to learn that. It's not on my high priority list right now, and I don't think it's going to give me that much more of an edge relative to the time I would need to put in to learn it. Maybe I'm wrong. Um, but and then when it comes to Elliott Wave, I would put myself at maybe a 6 out of 10. I'm not as granular as some of these Elliott Wave traders because it takes a shit ton of time to analyze all the sub waves, and I'm looking big picture. I don't really care about the sub waves and the sub wave of 1 and the sub wave of 3, and I don't really care. Just tell me where I am and I'll know where to figure it out from there. And that's probably for me as good as I need it to be. And again, you don't need to learn a lot of these techniques 100% of the way. You just need to know enough of it to give you an edge in the market, you know. And I can tell you, just being on FinTwit for the last, I don't even know what it's been, 6, 7 years. I mean, there's only a handful of Elliott Wave practitioners that I know that I really respect, that are like, I would trust their chart. And then there's a lot of people out there that are kind of like me. That's not to say I don't trust my own chart, but I trust where I know it is relative to the bigger move. I just may not know, the sub waves, and because things can get a little complicated. I shared a thread yesterday on Elliott Wave, and it gets complex when you start to see certain types of moves, like there's a WXY and there's a WXWZ, and it gets really, really complicated, and there's so many rules that I don't profess to know them all, but I know enough to be dangerous. And then when I marry that with my Fibonacci work and with pattern recognition and the levels, it makes you a much more proficient and dangerous trader. So, all right, let's I know, Zil, you wanted to take a look at B&L. Let me take a quick look at that just from a regular time frame. We're going to look at it on the daily. All right, so inverted head and shoulders. All right, I like it. Right, so there's your neckline. There's your left shoulder. There's your head. There's your right shoulder. The left and right shoulder, not 100% symmetrical, but that's okay. I think this is still a really, really valid. You're doing it on a 4-hour TTM squeeze. Yep. So let's redraw that here. So head, left shoulder, right shoulder. There's your 4-hour squeeze. It looks like it fired today. Break over the 200. Let's throw the 200 on. Yep, break over the 200 plus the 50% fib line. Let's throw a fib retracement here. So I don't know where you got I think you're thinking maybe this swing, the shorter time frame swing, maybe. I like to start with the larger time frame swing, right? So we're right under the 382. but you could look at like a shorter duration swing right here. Let me just change the color on that so it's a little more clear. And we just broke over the 618 of that retracement. So that's pretty decent. Ultimately, I want to see this over 1575. I think that's where you kind of need to be. 1551. Yep, that's a 382. I like that for an entry. Your stop at 510. I think that's good as well. And then your target 610. All right, so I think your risk to reward ratio is not good, right? So if your target is 610 and then 667 or 1667. So that's a little closer, yeah. But the problem is you're going to run into that 618 right there. And so your risk to reward is a little bit out of whack. It's probably closer to a 2-to-1. And so when it comes to risk to reward, I really would prefer a 3-to-1 risk to reward, meaning you're willing to risk $1 or $1 for every $3 that you could potentially make. You never want to put yourself in a position as a trader to potentially do a 1-to-1 or a 2-to-1 because the risk is just not worth the reward. The other thing too, the 4-hour squeeze already has fired. So maybe we get another 2 to 3 days movement higher, but I think this probably stops at 1575. You might be better off waiting for the test and maybe a back test on 1551 or yeah, it's hard. It's really hard to determine what the right move is here. I would have loved an entry maybe off of the 200 SMA and right, and then you could have like let's say you took the trade right off the 200 SMA. Let's say you got in here, right? And then your target was the neckline and your stop was the low of that day. Now that's a 3.5-to-1 risk to reward. That's pretty good. So just be careful when you're doing when you're determining the potential move, make sure that it's a 3-to-1 risk to reward and you're not giving yourself too many obstacles in the way, right? Here we have a larger time frame 382, a larger time frame 50%, a larger time frame 618. We also have the neckline as a potential resistance. So the cool thing is you do get that golden cross. You get that 50 crossing over the 200 SMA. So that's pretty good. Hopefully that makes sense, Zilla. All right, so JDC saying I have issues with Elliott Wave because where one wave starts or ends seems awfully arbitrary to me. Yeah, listen, I think when I first started using Elliott Wave, I felt the same way. And again, I'm not looking to find wave 1 or 2. I'm looking for wave 3. I'm looking for wave 4. When you start understanding the rules of the waves and how they work, it starts to make a lot more sense. So, yeah, I think at some point I will do a workshop on Elliott Wave. I think there's probably a bunch of workshops I'm going to do before that. Like I'm definitely going to do a couple of probably 2 or 3 fib workshops, one more specifically on retracements, one more specifically on extensions. Maybe I'll do one on fib extensions or I'm sorry, fib projections or how to build fib clusters. I think that's a really cool one. And I definitely want to do a workshop on anchored VWAP. I think that has a lot more merit in terms of everyday use versus Elliott Wave. I don't think it's necessary as traders to know Elliott Wave. Does it help? Yeah. It does give me a slightly better edge than I normally would have, but it's like if I didn't know it, I wouldn't really miss it that much. But because I know it and I've spent countless hours studying, charting, playing around, back testing. Um, to me, it's an essential tool just for determining a breadth of move in a trade. So, all right, we're coming to the top of the hour. I've got time for maybe one more chart or maybe a question or a comment that maybe you want to chew on. So drop something in the chat. And if I don't see anything in the next like 30 seconds or so, I'll wrap this workshop up. Also, let me know, for those of you who have been to my workshops, let me know if this time works better than right after the market. I realize that, 4:30 is probably not very convenient for the people who have a 9 to 5. So I'm more than happy to move them to the evenings. I would probably move it away from Wednesday because I believe there is already a Wednesday evening, 8 p.m. Eastern Standard workshop. But happy to, especially for you guys and gals who keep showing up to these, I'm happy to adjust to your schedules a little bit because I want to make sure that I'm giving you guys and gals as much knowledge as possible so that it makes being here beneficial. Chris is asking, didn't quite catch it, but for ATR stop, is it ATR period 14 and factor 3 or 2? Yeah. So ATR period 14, there are some people that use an ATR of 10, and it's based on trading days. So it's the last 14 trading days, which obviously is not equal. Maybe it's better to be 15, right? Because then it's 3 equal weeks, or better to be 10 because it's 2 equal weeks. Or if you're on a, weekly chart, maybe it's better to be an ATR 4. I'm sorry, a 4 period, because then it's 4 weeks in a month, or 12 because it's 12 weeks in a quarter, if that makes sense. So ATR, maybe change it relative to the time frame. But for daily, I think 10 or 12, sorry, 10 or 14 is probably fine. And for the factor, I would say 75% to 80% of the stocks should be a factor of 2. And then the rest, which are the higher volatility stocks, should be a factor of 3 to give you a little bit more wiggle room because they are a bit more volatile. All right. Well, that brought us right to the top of the hour. Really, really, really appreciate everybody that's come out to this live. I also appreciate everybody that's watching the recording of this. I do realize that not everybody can make it for everyone, but hopefully you've enjoyed this one. Let me know what you think down in the comments. Yeah, throw me a thumbs up, thumbs down. Let me know if there's something that you learned. If there's something you learned, throw it down in chat. I want to know, like, what people don't know, what people maybe want me to expand on. Yeah, let me know because I really try and tailor these based on the feedback that you guys and gals give me. A lot of you jump into my DMs and ask me questions and ask me to expand on some things maybe I said in live stream or in chat. And I appreciate that because now it gives me a better sense of where you all are at. So I can help you, take those baby steps to be a better trader. So awesome. All right. Yeah, I'll take a quick last look at Lemonade, LMND. I would always recommend go up to a higher time frame first. Okay, so I don't know. 1, 2, 3, 4, 5. Okay, here we go. So Lemonade. Obviously, there was a top there. To me, this looks like a 1, 2. This also looks like a 3, right? It's an extended move down. Guess what this looks like? Looks like a triangle. Well, what is the triangle usually? Wave 4 activity. So if this is wave 4, then this must be wave 5. Now, here, let's see if these levels are symmetrical. Okay, this is tricky because that low is 1029. That low was 1027. So actually, this low is lower than that low. So this can't be a 1-2. Okay, so I don't know where we are. It's very likely this has finished retracing. I do know, however, that this is likely a stage 4 decline. And this is likely a stage 1 base. I could be wrong, but that's what it looks like, right? And when you look up at stage analysis, right? What does that look like? It looks like this might have been like a stage 3. This is a stage 4, right? Here's your stage 3 top, your stage 4 decline, your stage 1 base. Here's your stage 1 base. Potentially, I don't know. But after a stage 1 base, you get a stage 2 breakout. So what do? Set an alert on 2343. You get a break above that, we might start, our stage 2 move. We've got a weekly squeeze setting up. That's pretty good. We've got a daily squeeze that just started to set up. So yeah, I mean, that's kind of what I would look for. I mean, look, rejection. We didn't quite get there. So yeah, I mean, I'm not really interested in lemonade. I don't think you should be interested in lemonade. But I would set an alert at 2343. And if we get there, then we can make a determination of, is this thing ready to break out? Good, right? It could, but we just don't know yet. And these stages, right? This right now is a weekly time frame. This consolidation has been happening for almost 2 years. So do you really want to watch a chart for 2 years? No. Set an alert and forget about it. Move on to names that are actually moving in the direction that you want them to move, right? That's all I got. I've given you everything I have today. I'm at the end. This is it. All right, ladies and gentlemen, thank you so much for being with me. I really appreciate your time. I see a lot of familiar names that show up week in, week out, and I really, really appreciate you. My job here is to try and give you as much education and pass on as much of my knowledge to you as possible. Mind you, I've been doing this for well over 6 years, probably 4 to 5 years in a full-time capacity. And it takes time. I was not profitable for the first couple of years. And there are months where I still struggle to make larger gains. So this is not an easy job. It's not. And you need to treat it as a job. You need to treat it as a business, as a side hustle, not as a hobby. If you're treating this as a hobby, just buy an index fund and call it a day. But if you really, truly are passionate about this, minimum you have as a time horizon is 3 to 5 years. You have to put the time in. The more time you put in, the faster you'll get to where you are. And one day, trust me, one day you will have that aha moment and be like, shit, I've been waiting for this day and it's finally here. And that doesn't mean you're done. It just means you've passed that first hurdle. And then after that first hurdle, it's how do you run and get to that next hurdle? And that's what this is all about. So keep showing up, keep doing your homework, keep charting these names, keep taking trades, make sure you're journaling, make sure you're reviewing your journals, make sure you're learning from your mistakes, make sure you're building your rule set, make sure you're following your rules, and just repeat, and repeat, right? Have a great night, everybody. Take care. I'll see you all in the morning. Actually, you know what? Market's closed tomorrow. I'm going cherry picking and then probably margaritas in the afternoon. Enjoy the day off. I will see you all on Thursday.